A groundbreaking study just dropped, and it's going to completely shift the way we think about retirement in the US. So, if you're planning for retirement, this could change everything you thought you knew about retirement. Now, here's why. For decades, planning software and advisors have assumed your expenses just inflate by 3% every year, year after year. The result? People get told they need a massive nest egg, sometimes way bigger than they actually do, which keeps them working longer, saving more than necessary, and feeling constant anxiety about running out of money. But JP Morgan just analyzed 280,000 households and found that reality looks very different. Spending just doesn't rise forever, it curves, it surges, and it fluctuates. And unless you plan for those shifts, your retirement could look nothing like you expect. So let's dig into the three biggest surprises. And more importantly, let's talk about what you need to do about them. Welcome to Your Retirement Elevated. If you're new to the channel and the show, I'm Scott Dugan. I'm a financial planner and been doing this for over 25 years. We've all heard it. Spending just keeps going up forever because of inflation. Well, that could be wrong. The truth is, spending actually declines with age, but the categories shift. Example, travel, entertainment, dining out, those taper off. Healthcare and charitable giving, those rise steadily over time. So check this out. At age 60 to 64, households spend about $75,000 a year. By their 80s, it's closer to $52,000. That's a huge difference. But notice what grows. Healthcare. By your late 70s, it's one of the largest line items in your budget. Now, here's the kicker. Real spending grows only about 1.8% per year versus 2.8% in inflation. That gap compounds over time. It means retirees may not need as much as they think, but they do need to prepare for concentrated expenses in the latter years. Now, let's think about this from the client's perspective. I've seen this firsthand. Clients in their 80s aren't suddenly jetting off to Europe twice a year. They're spending more time at home, giving more to kids and grandkids, and writing checks to healthcare providers. The inflation straight line assumption simply doesn't match reality. So, what can we take away from this? Don't build a plan assuming every expense grows at 3% forever. Dial down the assumptions for lifestyle categories like food and travel, and dial up assumptions for healthcare and long-term care, which can climb at the rate of about 6% per year. This shift alone could mean you don't have to work as long, save quite as much, or carry as much retirement anxiety as traditional software suggests. So quick pause here. If you want a retirement plan that adjusts with these real-world spending shifts, not just cookie-cutter inflation numbers, let's connect. We'll drop a link in the description below, schedule a quick call with one of my team members, and let's make sure your plan matches your lifestyle. Now, here's something most people don't expect. 53% of households don't retire all at once. Maybe one spouse keeps working, maybe you consult part-time, maybe you ease out gradually. When work income overlaps with retirement income, spending actually spikes in the early years. You can see it clearly here. Households that fully retire, which is the green line, tend to keep spending steady or even lower. But households that partially retire, it's the blue line, their spending actually climbs. And the implications are big. The study found partially retired households tend to spend more, retire later, and often keep working longer. Not always because they want to, but because they're juggling higher debt and bigger spending needs. So if you think about this from the client's perspective, I've looked at it, I've had couples come in where one spouse retires while the other keeps working. Sometimes they take those early years to splurge, maybe a new RV or big trips they delayed for decades. I actually had one couple who bought a $150,000 RV the very year they transitioned. It was fun, it was planned, but without planning, it could have been a big financial gut punch. So what we can take away from this is expect an early retirement bump during the go-go years. Now, don't be fooled into thinking retirement spending instantly shrinks the day you leave work. That's not reality. And you want to be very careful to manage debt before retiring, or that surge can compound risk much, much faster. This is why flexible income streams, pensions, Social Security timing, and a withdrawal strategy matter so much. They let you bend with lifestyle instead of breaking the plan. Now, here's the final myth. Retirement spending is steady and predictable. Well, let me give you a reality check. 6 in 10 retirees experience swings of 20% or more in a single year. Now, take a look at this. Right after retirement, 60% of retirees see big swings. And even by age 75 to 80, half are still bouncing up and down. And here's how it breaks down. Fewer than 2 in 10 retirees are what we call steady eddies. The rest, they're upshifters, downshifters, or full-on roller coasters. And so we see that. And with our clientele, we're very fortunate. We have a lot of data-driven professionals, either former engineers or people in the technical industry. So we don't see a lot of wild spending. Our folks are pretty steady eddy, and they like to plan for things. They like to know how much they can spend, and they do a lot of things willy-nilly. Think about where you are in the steady eddy, upshifter, downshifter, full-on roller coaster. We can handle any of those, but we tend to find most of our clients are steady eddies. If they are upshifters, it's in the upshifting that go-go years, like usually the first 10 years of retirement. Now, let me give you an example of a couple that came into our office not long ago. Now, they tightened their belt after a market dip, then loosened it again when the recovery came. That's a classic temporary downshift, then an upshift. Another took a surprise $20,000 vacation after selling a property. That's a temporary upshift. And of course, we all know families who swing wildly year to year. One minute buying a new car and redoing the kitchen, the next panicking about medical bills. Now, here's the danger. If your spending surge overlaps with a market downturn, that sequence of returns risk amplifies. You're pulling more from your portfolio just when it's dropping, which is the recipe for depleting savings faster than planned. So first and foremost, keep liquidity. You need cash and conservative assets for unexpected swings. We call it having dry powder or your war chest. You could utilize a bucket strategy, meaning we've got short-term cash, mid-term bucket for income, and a long-term bucket for growth. And lock in guaranteed income for essentials through Social Security, pensions, or setting up some sort of protected income source. What this will do, it'll give you the flexibility when life throws you curveballs without derailing your retirement. So let's recap real quick. Spending follows a curve, not a straight line. Retirement often starts with a surge, and don't forget, volatility never fully disappears. The danger is this. If you plan with the wrong model, you may end up chasing a retirement number that's bigger than it needs to be. That can keep you in the workplace longer, saving harder, stressing more, when in reality, the data shows most retirees spend less over time and shift where the dollars go. The point isn't to spend recklessly. It's to plan realistically, because when your plan reflects how retirement actually unfolds, you can make decisions with more freedom, more confidence, and a lot less anxiety. If you want a roadmap that adjusts with real life, not outdated assumptions, let's sit down and let's build it together. Link to meet with one of my team members below in the description. Now, there's no cost, no obligation, and absolutely no pressure, just a chance to get clarity and confidence about your personal situation. So good. Thanks for watching today. And if you haven't yet, like and subscribe and help the channel out. We'll see you next time.
Are you on the path to retirement but feel uncertain about your direction? Don't let myths and misconceptions cloud your journey. Before stepping into a lengthy retirement, gain clarity and confidence with a complimentary financial review. Schedule a conversation with Scott Dugan. It's completely free. Just click the link in the description below or call us at 913-393-4724. Let's start a conversation about what's most important to you as you plan for a successful retirement.
This podcast has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this podcast is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt, Mark Killian, and Third Wheel Media LLC are not clients of Elevated Capital Advisors. They receive cash compensation for their assistance in preparing and hosting this podcast, and for providing the endorsement contained in this podcast. Because Walter, Mark, and Third Wheel Media are compensated in connection with this podcast, they have a material conflict of interest in providing their endorsement.